Hey everyone, today we're going to look at two popular ETFs, SCHD, which is from Schwab, and of course JEPQ from JP Morgan Asset Management. I know picking between them can be tricky, so let's break it down in simple terms. What are these ETFs? Well, the Schwab dividend one, which is again ticker symbol Sierra, Charlie, Hotel, Delta, follows companies that pay good dividends, regular payments to investors. On the other hand, Juliet Echo Papa Quebec follows the biggest companies on the NASDAQ, like Apple and Microsoft. Let's dive in and look a little bit closer at these two right now. As you can see here, Morgan Income ETF, very high at 9.76%. As you can see, that's extremely high. And then the expenses are pretty reasonable at only 0.35%, particularly when you look down here and see what they're doing. As you look, you can see that they are basically writing out of the money NASDAQ 100 index call options. So they are using call options to produce this astounding income of 9.7% currently. This year, they're already up 3%. That's only 22 days into the year, as you can see right there. And then if you look, you can see here, they're kind of comparing themselves to other types of investments. So super high yield is number one. Is one first thing that we're going to notice. Second thing that we're going to notice is we're going to go into the actual portfolio itself. We can see it is jet fueled. I mean, literally, NVIDIA, Apple, Microsoft, Amazon, Google, Meta, Tesla, Netflix. I mean, literally, it is a technology driven portfolio. You can see the sector exposure here. Information technology, 42%. This is in no way a defensive sector. This is a growth sector. Communication sector, growth sector. 50% of this portfolio's, of this particular ETF is growth. So we can see very clearly it's a high yield with technology stock. That's what you're looking at with the JP Morgan. Let's go over to the Schwab, and this just also confirms that right here. It's got about almost 21 billion in it. It was launched May 3rd of 2022, so not quite as much track record as the Schwab dividend one. Jump into the Schwab one on the other hand, and here's the Schwab one. It's another low cost one, even more low cost, and we'll begin to look at the Schwab dividend yield. This particular one, as you'll see right here, has 65 billion. You see that right there where my cursor is, 65 billion. It was launched in 2011, much longer. Got 101 securities, a very inexpensive expense ratio, 0.06 versus 0.35 on the other. You can see it tries to track the Dow Jones US Dividend 100 Index, and it's done a pretty good job of that here. Stays pretty close, a little bit lower. It's lower by about what its expense ratio is. And you can see that the turnover ratio is about 28%, which means about 28% of the stocks in this portfolio are sold every year, which wouldn't be that great for taxes if you want to hold in a taxable account. Dividends, I'm less concerned about as far as taxes go. You can see it's got a lower price earnings ratio than the S&P 500, which would indicate that it's value stocks. But what does that mean? Now it says we're up to 67 billion here, which is as of January 22nd of 25. So as we can look, we'll kind of scroll down here and look at the portfolio itself. You can see more of the defensive positions with Cisco, Pfizer, Texas Instrument, Coca-Cola, Chevron, gets into some energy there. And if we go in and look at the actual sectors of the Schwab dividend paying ETF here, you can see that financials, that's not really that defensive at all, actually. So that's, healthcare, yes, that's about 17% in defensive. Consumer staples, yes, that's another 14%. So we can go ahead and take that up to, let's call it 31%. And then let's go to utilities. Not much. Utilities is the most defensive sector of all. And this particular ETF does not have that. However, about 31% are in healthcare and consumer staples. Those are defensive. So that's kind of what we're looking at there with both of those. I just want to kind of take a look at both of them with you. Now, let's continue and really kind of continue to look at kind of what these are. So we go to the big differences, as we talked about. Schwab's SCHD is like a steady turtle, pays reliable dividends that are much less. Schwab dividends are at about 3%, 4%, whereas right now the JP Morgan one is at somewhere between 9 and 10%. Less up and downs for the Schwab dividend ETF, and it's also good for people who want a regular income. The Schwab dividend ETF simply just literally pays dividends right out from what the stocks are paying. There's no call option writing, there's no purchasing of options. It's just flat out buy the stocks, pay the dividend. The JP Morgan JEPQ, which is the JP Morgan NASDAQ Equity Premium Income Fund. Boy, is that a mouthful. Let's hear you say that 3 times fast. Boom. The JP Morgan one, obviously, it's a growth dividend scenario. It grows fast, it's technology driven, it has more price swings, but it's better for people that are okay with some risk. And where they put your money? Well, we already talked about it. Schwab puts it into everyday companies like grocery stores and healthcare, and JP Morgan, that particular ETF, loves technology company and exciting companies. Tesla. Let's have a good time with it. Which one's better? Well, it depends on what you want. If you want a steady income with a lower dividend rate and you don't want any options or futures inside of your ETF, you're going to pick that Schwab ETF, SCHD. However, if you want more growth potential and a higher dividend, then you're going to pick the JP Morgan NASDAQ Equity Premium ETF, JEPQ. You want less worry? Schwab in this particular scenario. If you're okay with more risk, pick the JP Morgan ETF that we've been talking about. Bottom line, both are good choices. It's like picking between a savings account and a growth investment account. You think about what matters to you, steady income or possible bigger growth. The other thing you could do is if you want a solid dividend strategy, probably ends up being close to about the same amount of risk as the S&P 500, but has much higher dividends. You could maybe blend them too. Maybe have 50% in the Schwab and 50% in the JP Morgan. And like I said, you'd probably end up with the same amount of risk and possibly return, although I haven't tested it, but a much higher dividend. If you did this today, you take the dividend at JP Morgan, we'll call it 10%, and you take the one at Schwab, and let me look real quickly here and see what the one is at Schwab. Call the one at Schwab 4%, so that's 14%. Average the 14% together, you're going to get a 7% dividend payout. So I think you really have to decide what you're doing there to choose between the two. You can always do a blend. You know, we're pretty conservative with our clients, so we use the Schwab one much more often, but I do like both of them depending on what you're trying to do. Remember, both ETFs are proven winners just in different ways. Pick the one that helps you sleep better at night. If you like this explanation, hit like and tell me in the comments, which would you pick and why? Or do you like the combo of the two? Also, if you want us to take a look at your portfolio or just talk with me at no cost and no obligation, go ahead and click on the link provided in this video, and we'll talk to you soon.